Before we head in today, let's just get an update on the applied level. The financial modeling begins September 9th. I'll be doing two companies. I'll be doing Costco and CapREIT. You are free to choose whatever company you want and follow along. I would just suggest you avoid any manufacturing companies for now because you'll have to make different decisions there. But instead of Costco, if you feel, well, I want to do Target or I want to do Walmart or any of the other big retailers, you can. Same with CapREIT. You can choose any apartment REIT that you want. There may be differences between Canadian and US, between IFRS and US GAAP in the way that they report line items, but you don't have to do the one that I'm doing. I've been asked if there'll be a standalone module for financial modeling that instead of getting the applied level, you could just get that particular module. No, I've decided not to. It's too complicated to get done because you do need some industry and some company analysis before you even begin to determine what your assumptions would be. Every company is embedded in an industry. To make an assumption about revenue growth, you have to understand the industry they're in to determine whether or not it's a realistic projection. So it's important that you have the videos that go with each sector. So they will be included in sector studies, which is 220 US. The applied level is 440 US. And if you get these sector studies, you can upgrade to the applied level anytime for full credit. You get the 220 towards the whatever price the applied level would be at the time you upgrade. You'd get your full 220 as a credit. I've looked at other companies that do financial modeling. There's a half a dozen of them out there. And they're anywhere from $295 up to some as high as $2,500. They're significantly more than 220. And they do okay. You get anywhere from 6 to 10 financial models. You know, one of a bank, one of a mining company, one of this or that. I'm only starting with two, one in consumer staples, one in real estate. I will do one for all 11 sectors. So we will do more of these as time goes on. But at 220, it's still significantly lower than what you'd pay for just their financial modeling to begin with. With CapREIT, the video that goes with it, Understanding Residential REITs, I would suggest that you watch that one first. I don't have one for understanding retail in a sense like Walmart, Target, Costco, only because it's pretty obvious. It would be a short video. There's not a lot to figure out. Right? You've all been to Walmart before. You've all been to a Costco somewhere or Target. You walk in, there's stuff on the shelf. You put it in your cart. You pay. You leave. I mean, it's not a complicated business model to figure out. To prepare for this, get the 10K, not the Qs. Get the 10K for each of Costco and CapREIT. We'll be modeling 5 years historical data. When I say modeling 5 years, there are no real assumptions or decisions you have to make on that data. So it's not like we're modeling. We're just going to input 5 years of historical data, but decisions will have to be made. Every year or every couple of years, companies change their line items. So sometimes they might have had 3 line items that are now collapsed into 1 line item. So as you go backwards, you'll see more line items. You have to then say, well, what is it collapsed into? Because if I need a trend in a particular line item, and if these trends just keep ending and you have different line items appearing that didn't appear before, it's going to be hard to do. So we're going to have to make some decisions about what categories we collapse. And there are some line items where it's not going to be important. We can collapse them. So there is some work, first of all, in getting the historical data in. So we'll have to do that. Read each of the 10Ks. The 10Ks give you a full description of the business and what it does, and you want to get as good an understanding as you can about each line item. I will be doing that throughout the financial modeling. We'll begin with revenue. Everything starts from revenue. That's the first line that you model going forward is revenue. Everything starts there, and we'll spend some time on that. And watch the sector videos for both consumer staples and for real estate, and especially the Understanding Residential REITs video. I will be using some functions in Excel, and I'll tell you right now, I'm not an Excel expert by any stretch. I get by, but I'm not an Excel expert. Some of the functions that you'll use are the choose, transpose, if, min, horizontal lookup, row, and sum. These are probably 95% of all the functions that you would use. As you go through the videos this fall, you may say, oh, but there's a better way to do that in Excel. I grant you that. There probably is. As I say, I am not an expert in Excel. I believe Excel is just a tool and is 10 to 20% of the model. There is a philosophy to using Excel, which is you want to minimize the amount of hard coding that you do, the amount of formulas you put in cells. You want to minimize that as much as possible. The actual way that you do it, there's Excel is powerful. It gives you a whole bunch of ways to do things. You may say, well, I don't like this function. I like another function. I like if statements. I like the sum if statement. Go ahead. You can do whatever you want there, and maybe under the video in the comment section, you just leave a comment saying, "Hey, everybody, try this function instead." Great. One, there are two things that are different of the way that I will be doing this versus any other course in financial modeling you may have seen or that you may be thinking of taking. Number one, I'm using real data. Okay, I'm not going to use manufactured data. I've been through a number of these courses just to see how they lay it out. If there's any interesting things that they show that I think, well, that's kind of neat. Other than Excel tips here or there, I don't really find much because they use manufactured data. And when you're using manufactured data, you're just making up your assumptions. Right? And when you make up your assumptions, you never have to worry about, well, how do I even find this stuff? We're going to work with real data. So in modeling costs, for example, you always want to have a breakdown of what's fixed and what's variable. Well, oftentimes you're just not going to find that. So in the manufactured data, you can make an assumption. Here's our costs. This much is fixed. This much is variable. Let's go. It shows you how you would forecast out fixed versus variable, but it doesn't show you where to find them. So that's not very good in the real world. So I'm going to be using real data, and we're going to come across real world constraints in our data in terms of, well, where the hell do we find this? And once we see where all the limitations are, we'll then begin to appreciate all the other sources of data, like the conference calls, the earnings calls, when analysts ask information, because if you can't find the data, neither can they. Now you'll start to listen to their questions with different sets of ears, and you'll be saying, I need that piece of information. And then you'll want to go back through some of their conference calls to see if you can find all the missing pieces of information. And the calls going forward would have more little bits here and there where, I can tweak this line, and that gives me a little insight into this. And over time, your model will get better and better. So we're going to use real data. We're going to use real companies, nothing manufactured here. The second difference that I'm going to follow is that I'm going to make mistakes on purpose. We're going to make common mistakes that if you were just starting out, you would think, well, this is the way I would do it. We're going to make some common mistakes so that we can recognize the solution when we get to it. Some of the ones that I've watched, you're going to want to do it this way, and then they show how to do a schedule, and then they'll show you where to put the dates and where to put your CapEx schedule. You're going to want to do it that way, but they never really explain why you'd want to do it that way. Just you're going to want to do it that way. So other than just copying them, you can't really see the intuition in it. So what we're going to do, we'll start with revenue. We're going to forecast revenue. We'll have 5 years, and then we'll figure out what the average growth rate is, and then we're going to forecast forward with an average growth rate, which is not very good. It's not a good way to model revenues, but we're going to start there, and then we're slowly going to iterate to the best way. It'll take maybe 3-4 steps. We'll say, okay, can we do better? And we'll do one step better. Okay, can we do better? And we'll do one step better. Okay, can we do better? And we'll be forecasting a line item of which we can, since we have quarterlies, we can look at the quarterlies and see how close we are on a run rate basis to where the quarterlies are as we keep tweaking our model. So we'll look at the growth rate and we'll say, how close are we? We'll say, can we do a little bit better? And you'll see that with each iteration we do better, so that you'll understand what experience is. Because when you first start, you're just going to use a growth rate. Experience tells you, well, there's a better way to do it. More experience says, but I can do even better. And even more experience says, I can do even better. If I just give you this and say, look, this is the sum total of all experience, you're going to miss the journey. So I'm going to model the journey. And we're going to purposely do it naively, and we'll make mistakes along the way on purpose so that we can recognize why we would do it a certain way, why we would have a certain row or a certain column in a certain place, why we would never hard code into our financial statements, why we would always use the schedules. Every time we think we want to put a formula somewhere, you think, I should use a schedule for this. Everything should be in the schedules. So those are the two big differences. We are going to model mistakes and experience, and we're going to use real data. So just to revisit this point, sorry, there'll be no standalone module for this, but if you add just sector studies, you'll get all the sector studies. You get all 11 sectors so that you can get these two, and over the next year or so, more will show up. My goal, hopefully, is to have one every time I do a sub-industry, is to have at least one financial model of a company per sub-industry. Okay, let's head in. We'll start with the economic data from last week, Monday. Mexico and Canada. Mexico had consumer confidence 46.9, down from 47.4, and that was a revised downward number. So that's not good. Building permits. For Canada, this is month over month. I need to stress that because these are big numbers. This is for June, negative 13.9%, 14% drop in building permits month over month. And the previous month was revised downwards to almost 13% down. The expectation was an increase of 5.6%. That's a miss, a big miss, with a big sign change, like not just a little sign change here. If you look at realtor.ca in Toronto, you'll see there's huge Toronto condo supply on the market now, and the Niagara region, massive supply. A couple of years ago, when I was looking at the price of houses in my area, I think there were 2 pages on realtor.ca, 1.5 to 2 pages. There's about 40 pages now. It's incredible. It's the nature of our mortgage market that you get a 25-year mortgage, but it's fixed for 5 years. Every 5 years, the rate resets. So you got to go back in 5 years and you got to reapply for your mortgage again. So a lot more are hitting the market because people can't afford the increase in the mortgage rate. Couple that with buyers that are just saying, we're not stepping in right now. It's kind of known that the Bank of Canada's probably got 2 more rate cuts this year. So as a buyer, why would you step in at this point when, if you wait till the end of the year, mortgage rates will be 50 basis points lower than they are now? So buyers are just hanging out on the sidelines. Sellers are facing interest rate resets on a daily basis. People walking into their banks every single day across Canada, resetting their mortgage payments higher. So that helps explain why builders are saying, what's the point of building right now? So building permits pulling back. Even though you have a lot of supply coming online, you have more supply than demand only because the buyers are sitting on the sidelines. Structurally, you do have more demand than you have supply, and that will persist for years. If we look at the Canadian apartment REITs, they all had great earnings, and if you were watching CapREIT, what did CapREIT do this week? Raised its dividend. Not much, went from $1.44 to $1.50, but that's a good thing. So I will continue to hold the Canadian apartment REITs. This doesn't change my mind about anything. PPI came in on Tuesday, and this really just set the market on fire and everything disappeared. And if you look at the chart, we got this V-shaped recovery, and the day before was hard landing. The Fed needs to come in and do an intermeeting cut to, hey, there's going to be no landing at all. We're in the early stages of a bull market and growth is accelerating. What a difference a day makes, right? Let's see if that's warranted. There is a general lack of understanding of what PPI is measuring. Even on Bloomberg, when I listen to different people talk about, I think, but you're only talking about one part of PPI. The numbers that are reported here on this screen are not the costs for businesses. They are the costs for consumers. They're not the costs for businesses. You may think, well, okay, now I don't know what I'm talking about. So let's put the consumer over here. Let's put a business over here. A consumer comes to the business and spends money. CPI will capture that. The business receives this money, PPI captures that. When we're talking about PPI for final demand, it is just the other side of the transaction. You may be thinking, but is that not measuring the same thing? In some instances, yes, it's measuring exactly the same thing with a slight difference. CPI will capture sales tax because the consumer has to pay for it. So if there's an increase in sales tax, there will be an increase in the CPI. It captures sales tax. The businesses, well, that's not their money. Businesses don't charge tax, they only collect tax. So the business does not account for taxes because it's not theirs. The other thing is the business, PPI captures, at least for final demand, captures the money businesses receive regardless of who pays for it. Whereas CPI only captures the price of things that consumers pay for. So a good example of things that consumers receive but don't pay for, healthcare. They may pay their healthcare insurance, but they don't actually pay for the hospital visits, for the procedures. Same with insurance repairs on either the house or on their vehicle. They pay for insurance, but they don't pay for the insurance repair. But the repair shop receives the payment for insurance repair, and that gets counted in PPI. So PPI is what the business receives regardless of who pays for it. CPI is what the consumer pays for and only what they pay for. It basically is the other side of the CPI transaction. And again, that's final demand. Then you have your stages, stage 1, 2, 3, 4, and these are the costs for inputs along the production channel before they get to businesses. That's a smaller part of what's paid attention to. The numbers you see on the screen, the numbers that are reported, are the opposite side, the mirror image of CPI. This is for final demand. So it does matter. It is part of the cost that we would pay attention to if we're looking at inflation versus deflation. PPI month over month headline 0.1. The expectation was for 0.2. The core came in at 0. The expectation was for 0.2, and the previous month was revised down to 0.3. Let's look at these categories down here. PPI ex food, energy, and trade. Well, we don't have to look at the year. We'll just look at the month over month. Less food, energy, and trade, 0.3. It was 0.1. So that was an increase. Let's just dig into these numbers a bit and see what's under the surface. Total final demand, 0.1. That is the headline number. If we take food, energy, and trade, we had 0.3, which is this number here. Let's break down the 0.3 between goods and services, services being roughly 75-80% of this measure. Goods, 0.6. For CPI, we have seen negative or deflation basically on goods for quite some time. This is 0.6, services, negative 0.2. If we strip out food and energy out of goods, we are up 0.2. For services, it has different components. If you look at just the trade component, it was negative 1.3. The trade component is margins, so that gives us some idea of the profitability, perhaps, of the businesses. The trade, negative 1.3. So that's a big part of what's dragging services to negative 0.2. Transportation and warehousing was up 0.4. If we look at intermediate goods, processed goods up 0.7. If you take out food and energy, up 0.1. Unprocessed goods, look at that. That's huge. 3.6 if you take out food and energy, up 0.7. And intermediate use services, these are the stages now, 0.3. This is what the prices businesses would experience on the way in. This is the prices they get when their services and products leave their premises. So it is the opposite side. So overall, not bad. The negative, I see red, I want to say negative. The 0.1 on headline, the 0 on the core. But once we look under the hood for total final demand, it's ambiguous. Not only that, if we look at final demand for goods, you had 0.6 in July. You got to go back to February to get a number that was higher. Same with food. Food on its own came in at 0.6. You got to go back to February. Every month after that was lower. So it's the highest month since February. Same with energy, the highest month since February. And if we look at final demand for services and look at, let's say, trade at negative 1.3, that is the lowest it's been since July. And the numbers they give you, you get all the way up to July 2020. It's the lowest in a year. And this is speaking to margins. It's the lowest in a year. Still with PPI, looking at the stages, stage 1 to stage 4. July, the bottom line over here, what I've done in this chart is I've circled the next highest number. So this is 0.5. You got to go up to January to find a number higher. So for instance, stage 1 total came in at 0.7. You got to go all the way back to August of 2023 to find a number higher. It's the highest it's been since August of 23. For all of them, you have to go back several months. So stage 4 total is the highest since April. For stage 3 total, highest since February. Stage 2, highest since April. And here, highest since August of 2023. That's not really a good trend, but you'll remember from the previous screen, services, final demand, trade, negative 1.3. That's margins. So that is leading to some margin compression, suggesting that companies are finding it difficult to continually pass these costs through. And if they can't pass them through, which means the revenues aren't increasing as fast as they need to at a rate of inflation, but their costs are increasing, you're going to get margin compression. Moving on to CPI, this was a little troubling for me. I thought, well, I don't get the big celebration. I mean, once we look under the hood, we should be a little bit cautious and a little bit concerned. Here's the trend in CPI. You can see May came in at 0, June came in negative, and now we're back up to 0.2, which is what we had in December, November, higher than October, and the same as last July. So year over year on the month over month, not much progress, but we've had 0.2 and it jumped up, came down, and then it jumped up, came down. And how is this going to, go a little higher before it comes back down? I still believe that our path is down, but nothing ever just goes in one straight line. And if we're data point dependent, data point to data point to data point, as opposed to extrapolating the trend, what if the next data point is 0.3 that you get for the August reading, of which I believe the Fed gets it before that meeting. The Fed will get that reading before the meeting. It could take any rate cut off the table, which I think would be another mistake. Let's just look at some trends here. The core inflation rate year over year, if you go out a couple decimal places, 3.213. It was 3.277, so 3.3 down to 3.2 suggests that it was a 0.1% drop. It was 0.64. That was to the core. The inflation rate year over year, 2.924. The month before was 2.976, so it dropped 0.52. This suggests that it dropped -0.1. So much information in the second decimal place. Let's look at inflation rate month over month, 0.1549. Here it's suggesting it came in as expected, and that it was a big jump. We had -0.1, we were expecting 0.2, we got 0.2. That's suggesting that it increased by 0.3. But this reading here was -0.056, so it was rounded down to -0.1, and this is 1.549. So really, it's not a 0.3 jump, it's a 0.2. Still okay, it's 1.88% annualized. Core inflation month over month, 0.165, which comes in right at 2% annualized. It was 0.065 the month before. So this is, the 0.1 to 0.2, suggesting a 0.1 increase. It basically was a 0.1 increase. Even at 0.165, 2% annualized. The bigger, more important number here is Supercore. Negative 0.014 month over month. That's 1.77%. If we look at it year over year, it's only 1.77%. The Supercore is well below 2% on a year over year basis. This is the third month in a row, by the way, that Supercore has been negative. The third month in a row. If we look at rent and owner's equivalent rent, makes up 36% of the CPI. May, June, July, 0.4, 0.3, 0.5. That's going in the wrong direction for rent, 0.5. Owner's equivalent rent, 0.4, 0.3, 0.4. No progress here. So by taking this out, and there's no progress here because, well, you're not building any new houses at a pace fast enough to increase the supply. So you have a situation where you have interest rates at this level, but rents at elevated levels and continually to go up, and housing prices, and in some regions hitting all-time highs. So looking at the Supercore, because again, housing being so interest rate sensitive, with high interest rates, you are actually constraining supply. Take that out. Supercore, 3 months in a row, less than zero. There is no reason to pause on rate hikes. We're seeing up here that businesses are willing to take margin compression at this point. They're less willing to pass through costs, and you have a Supercore that for 3 months in a row has shown deflation. It is time to cut. However, if you get, if we ignore the underlying trend and you get this little bounce, like it's 1, 2, if you get it again before it goes down, before that meeting, you run the risk of no cut, which I think would be the second mistake. I think they should have cut already. Wednesday, we also got oil inventories. Expectation was for a drawdown of 2 million barrels on crude, West Texas Intermediate, increase of 1.3, and gasoline drawdown of 1.4, drawdown of more than double that, 2.9. Thursday, going into Canada, new motor vehicle sales, 187 was the previous month, down to 168. Remember, building permits were down as well. Wholesale sales, month over month, for June, negative 0.6. The expectation was for negative 0.6. The previous read was negative 0.8. Going into the U.S., retail sales. Too much celebration on this number without zooming out a bit and looking at the trend. Celebrating 1% up. The expectation was for an increase of 0.3. That beat expectations. The previous month was revised down to negative 0.2 on an unadjusted basis, because these are adjusted. On an unadjusted basis, July was up 3.175% above June. Taking out autos, up 0.4. The expectation was to be up 0.1. The previous month revised upwards. And if you take out gas out of that as well, 0.4. The previous month was 0.8, so that is a drop down. May, June, July, retail sales. June, retail sales. July, retail sales. There's your 1%. That's why it looks so good. It's because there was a big drop in June. However, on the unadjusted number, if you draw a straight line from May to July, July came in on an unadjusted basis 2.75% below May. Unadjusted means just add up the add up the amount of money. Don't adjust for any seasonality, just add up the amount of money. Came to 2.75% below May. If we adjust it based on seasonality, it is 0.76 above May. So if we take May, June, July, and you take 0.76 and you do a linear interpolation, it would have meant that July would have been roughly about June would have been 0.4, July would have been about 0.4 as well above May, not the 1%. If we take the trend, this will make the month after it look really good, because you had a really bad number here and followed by what looks like a really good number. But if you take out the middle and you just look like May over July, it's not that great. Export prices month over month for July up 0.7, and the previous month was revised upwards to negative 0.3. Expectation was for 0.7. Import prices month over month up 0.1. The expectation was that it would be negative 0.1, up 0.1. Going into the labor market, continuing jobless claims came in better than expected, came in better than the month before. The month before was revised downwards as well, 1,864,000. Claims 227, expectation was for 235, so this is looking good. Philadelphia Fed Manufacturing Index. I've been showing some of the manufacturing indexes, over time. They're not doing very well. 13.9 now down to negative 7. The expectation was 7. I think there's enough evidence to suggest that the economy needs the attention now. And when we really focus in on Supercore for CPI negative for 3 months now, what are they waiting for? Okay, last screen for economic data, I swear. I think it's become more important. Rates now are, I used to start with rates, kind of less important, more of an outcome now than a cause. Industrial production for July month over month, negative 0.6. The expectation was for negative 0.3, so that came in worse than expected. Previous reading revised down to 0.3. Year over year, negative 0.2. Capacity utilization down 77.8%. It was 78.4, 77.8. That is capacity being sidelined. When you see capacity utilization dropping, it's usually not a good thing. That usually comes with employment dropping as well. Manufacturing production month over month, negative 0.3. None of those are good. Already showed you this earlier, you will see this a little later. I already showed you this earlier. We have this coming up. The housing market index, 39. Previous month revised downwards to 41. Expectation was for an increase up to 43. Came in at 39. That almost sounds like it's Canada there. Michigan consumer sentiment, kind of bucking the trend here. The underlying economic data appears to be deteriorating. 66.4 up to 67.8. That's a fairly big jump. Consumer expectations, 68.8. This is what they expect. 68.8 to 72.1. We look at current conditions, 62.7 to 60.9 is like currently, but we expect it to get better. That could be optimism with the upcoming election. Democrats are optimistic. Republicans are optimistic. Everyone's optimistic because everyone thinks their guy's going to win, or their person's going to win. Baker Hughes, the oil rig count down to 483 from 485, and total rig counts 588 down to 586, both of them dropping. This is because oil companies are relying more on enhanced oil recovery versus drilling new wells. So you can get more out of an existing well before you have to drill another well with different techniques for enhancing the oil recovery. All right, looking at rates in the money market, very boring stuff going on here. Looking at yields in the capital market, also pretty boring. Out to maybe the 7-year, the 10, the 20, the 30, showing some basis point movement there. The 10-year still hanging out under 4%. Only the 10, the 20, 30 have higher yields than when they started the year. Looking at curve inversions, the 2 to the 10, negative 17, 774 days on that one now. In Canada, negative 24.6. The 3-month to 10-year, the money market to capital market inversion, 144, 657 days on that one. Canada's negative 120.4. Not a lot going on with the balance sheet. Things have gotten really boring over there. The SOMA's down 66.5 million. Not even a billion. 66.5 million. Hardly anything. So we're basically unchanged. 6.617 trillion in securities. The full balance sheet, 7.177 billion. That's an increase of 2.36 billion week over week. It's nothing. Money market funds increased again, 28.38 billion, 6.22 trillion hanging out here. Retail up 2.4, institution up 26 billion. For retail, governments down 1.17, institution added 31 billion, and then opposite on prime. Retail added 4 billion on prime, and institutions decreased 5 billion, but still getting increases. We've had basically this in the SME and this. You've had a V-shaped recovery, and we are still increasing in money market funds. September 18th, FOMC, 31 days away. We get the minutes from July in 3 days. That'll be an interesting read. Heading out to September 18th, what do we have? 25 basis points. Almost 3/4 probability on that. 72.5, 50 basis points, 27.5. That's really increased 72.5 from 51. The week before it was even odds. Now it's looking more like it's going to be 25 basis points. You get a read in CPI in September based on August data, and if it is a bounce and they don't look at the longer trend or pay attention to Supercore, and you get a strong jobs report coming out beginning of September for August, you could be putting another arm in here for zero basis points, because this Fed is cautious. They don't want to go back to the Arthur Burns era. None of them want to be remembered that way, so they're being overly cautious. I seem to think that 25 is the base case. I don't think that zero is going to happen regardless of what the data is. I think your 25 is your base, maybe 50 if the economy is in fact deteriorating and the data continues to show that. The data since the pandemic has been, I'm not going to say questionable, but it's been unreliable. Jackson Hole begins in 3 days, and that's on Wednesday, and then on Friday the big man comes out 10 a.m. And he may give some indication of what they're thinking about for September. Canadian CPI in 2 days, and Mexico GDP. It's the final look at Q2, so it's not going to be that market moving, but let's just be aware that comes out in 4 days. Not a lot of Fed speak this week because, well, you got Jackson Hole and they'll all be hanging out there for their free vacation. Monday you have Waller. I shouldn't say their free vacation, their taxpayer paid vacation. Monday's Waller, Tuesday Bostic and Barr. But this will be the focus of the week. Earnings this week are Nvidia's not till next week. It seems that earnings season comes down to one company. Will this rally continue? It's going to depend on Nvidia, because that's the whole AI hype. Nvidia stumbles, the market stumbles. Going out to December, for more than 3 rate cuts. Last week was almost 76% probability of more than 3. Now we're down to 60% for more than 3. The effective federal funds rate unchanged. It's not going to be changed till the Fed actually does something. Reverse repo bounced up a little bit, 18 billion, still in the 3s. The TGA up 3.6 billion, reserves down 34 billion, which puts it at 29, the combination of reserves and repos, 29 months at the current rate of runoff before we hit ample reserves. Not a lot of excitement in the real yield space or the break-even rate space. You got low volatility in nominal rates. You'll have low volatility here as well. For Fed funds futures, Q3 pricing in 32.5 basis points, kind of a split between one rate cut and two rate cuts, but Q4 65, still looking at 100 basis points cut this year for basically 425s. Last week was 103.5, so it is pulled in a little bit going into Q1 of next year, another 51.5. Q2 another 30 for another 81. So looking at 179 basis points for the next 4 quarters, 7 rate cuts over the next 12 months. TLT had a good week, up 1.23. SPY or SPX, SPY, 3.93. Implied volatility disappearing. I closed my 102 calls. I leave them open. I've made no other changes on TLT at this point. 30-year mortgage rate holding tight below 6.5, 6.49, up 2 basis points. The 10-year U.S. Treasury over that time dropped 7, so the spread increased by 9, 257 basis points. Agency and Annaly both green for the week. ABR down 1.25. And the home builders kind of mixed. Pulte and KB Homes are the only negative ones. Look at this little guy. If you can grab a hold of that thing, that volatility is incredible. It should have options. It's a crime to have that much volatility and not have options. I think it's just a crime. IYR, hardly anything on the REIT index. XLU up 1.13. TLT, remember, was up 1.23. It is really beginning to behave more in line with changes in rates. OAS, all contracted. Still nothing exciting to see here at all. This is huge. Mortgage applications for August 9th. Remember last week we were at 6.47%. Look at that. Up 16.8% on mortgage applications. That's a big jump. The housing market index, which I've already shown you, came in at 39. Previous was 41. This is for August. Building permits for July down 4% month over month. Housing starts. This is a big number for July, down 6.8% month over month. Both building permits and housing starts down. The housing market index at 39, and these guys going up on the expectation that lower rates will create more demand. But as far as home builders, this is the stat to look at. This is the stat to look at. This is the stat to look at. None of that looks good. Thursday, existing home sales. And Friday, we have new home sales. Again, that speaks more to the builders. This speaks more to mortgage apps and to where the level of rates are, level of consumer confidence. Can't let this week go by without talking about gold. On Friday, closed at 25.0820. It is an all-time high. This is a one-year chart of gold. Look at this. It is an all-time high on gold. But at the same time, the dollar index is at a 3-month low, closed at 102.25. If it breaks 101.934, closes below that, you're you would be a 6-month low, a little more than a 6-month low. This was on March 7th. Break that, and you're heading to a 6-month low on the dollar index. So that gives some support to commodities denominated in US dollars. Newmont broke $50, closed at 50.03, up 22.73% year to date. They are a big gold producer, and their byproduct is copper. FCX, the opposite, copper producer, their byproduct is gold out of Indonesia. The nice thing about FCX, they've got their local smelter operations underway in Indonesia, and any copper output from here has no export duties. They export copper concentrate, they have export duties, so those will disappear, which will just increase margins on their copper side. Copper finished at 415.10. I had 405 puts This got a little uncomfortable in here. It had a nice day on Thursday. I thought, well, let's close those puts while they're in profit. So I was faced with the decision of a certain gain of 50% of the premium or an uncertain possibility of 100% of the premium if I waited another 2 weeks. And I thought, no, I'm going to take it. You have Jackson Hole coming up, and if he suggests that they're just not there on the 50 basis point rate cuts, that the market is way ahead of itself, that could strengthen the US dollar. You strengthen the US dollar, these prices have downward pressure. I mean, they can still go up with a strengthening US dollar on their own fundamentals, but it still would put downward pressure. But if you are watching gold, all-time high on any technical chart, there is no line of resistance above this. The price target I saw thrown out this weekend was next stop $3,000 from 2,500. That probably would put Newmont at multi-year highs. I think they have to get above $56 or $57 to get there. By the way, that would also help Freeport. The amount of gold they produce out of Indonesia, they sell, just in selling that makes the cost of running that mine negative. In other words, they're already profitable just selling the gold. Copper is basically free. It has a negative cost per pound. Isn't that beautiful? Okay, let's look at SPY. Some of you may be saying, hey, you missed new positions. When I started doing new positions, I did say there'll be some weeks where I do nothing, where there's just nothing to do. This is one of those weeks where there really was nothing to do. I reduced some positions, some of the options that I sold when volatility was high. I reduced more of those. And I added to some short positions, especially the Tesla short position as it ran up to 215, 216. I added to that. Other than that, I have no new positions. And this is normal, that there will be weeks where there's nothing going on. And there's too much uncertainty, and we're in between big events. The earnings season is pretty much over, but what do we got in front of us? You got Jackson Hole and Nvidia. Those two events alone can change the direction and the tone of the market. So, at this point, I don't feel that there's anything I really care to add in front of that. And last week was, what did we get? We got this nice big rebound. I did a whole bunch of stuff here to add volatility. And volatility paid off over here, and I still had all my other positions. I thought, I'm good. But look at that. We got a nice, the world is in trouble. The Fed's got to do something too. Hey, you know what? This is the start of a new bull market. We're going to hit all-time highs. Everybody step aside. Things are great, absolutely wonderful. Isn't that incredible? Forward, 4-quarter operating earnings, LSEG's 258.31. Which is a small drop from the week before. SPGlobal 257.36, small drop from the week before, but the market really went up. So we're back over 21 times forward earnings, 21.5 times forward earnings versus 20.7 the week before. The surprise factor is still sitting at 4.5%, down from the 8-point-something% we saw in the previous quarter. Implied volatility in the 60s across the board. I drew a straight line for implied volatility here. You can see some periods where it was higher, and this was really beautiful. I'm still a little sore at the market makers and the way they handled it on the open. They weren't letting anybody into anything at all. I could have done so much better. When you get those big spikes like that, they don't last long. That is not a time to be timid. You take whatever you can, and they just, by the time I was getting in, I mean, the VIX had opened up. It was around 55, 56. By the time I was getting in, the VIX was down to low 40s, 41, 42, and it's still on some of the ones that I wanted in on, I still couldn't get in. That by the time I got in some of those, VIX was in the mid-30s. I could have done so much better. I did okay. I did okay. This was sort of a gift. It was nice, because you're going along with your strategy, and then the market gives you this volatility. It's like, I'll take some of that, thank you. But I could have done so much more. I'm just now I'm concerned. What if you get another nice scare, and the VIX spikes and the market makers just say nope, nobody can have this? That's a little upsetting to me. I'm gonna have to find a new way to play it other than with the options. Earnings this week: LSEG says 16, Sector Spider says 13, SPGlobal says 12. Not a lot that's exciting. You have Lowe's this week. You have a few of the retailers. I think Target is this week, and I think 2 or 3 others in that space. Dollar General is this week. Not worth going through the calendar. I don't think any earnings are really going to move the market. There's nothing significant enough out there that's going to move the market. It's Jackson Hole this week. That's the focus. It's NVIDIA next week. That's the only thing that's going to matter is NVIDIA, and that'll close out August. And that's it. I will be online as usual at 7:15 p.m. Eastern Time. If you think better in terms of cities, that is either Toronto time or New York time.